Hi, I'm Tracy Sofra and welcome to the Women of Wealth podcast. Let's talk about insurance. Yes, I've got you excited, I can see. Let's jump straight in. It's a dry topic, I'll give you that. But when planning out your financial life, it's so important to make sure that you've accounted for life's uncertainties. And there are some uncertainties we don't like to talk about, but it is part of life, and insurance is one of those necessary evils that gives us comfort when we know everything is in place. We never know what's around the corner and what might happen, but it needs to be said that insurance such as life, TPD, which is total and permanent disablement, income protection and trauma are a critical component or are critical components of planning for your future. Picture this. If anything was to happen to you, what would happen to all of your financial plans that you have set up? So imagine all the goals that you've set, budgets you've set up, banking, got it all in progress and it's all working beautifully, ticking along, and you're so proud that you've come so far and you're keeping all over it, doing all the right things, and something all of a sudden happens to you. An illness, an accident, something that's out of your control. What if you couldn't work anymore? And what if you got diagnosed with a life-threatening illness? What if you became permanently disabled? What would happen to your current state of financial affairs? This is what you've got to think about. This is the ugly truth. What would happen to any dependents you might have? What would happen to you? Major things to consider. Luckily, there are insurances that can protect you against all of these nasties, and that is what I'm going to be talking about today. Let me state from the outset, I know insurance is not much fun, as I've said. No one likes paying it, right? No one really does. I get it. But let me ask you another question. Do you insure your house? Do you insure your car, your contents? I'm guessing that's a yes, because most of us do insure the car, house and contents. We insure every other thing except ourselves, the most important person in this equation. You are the greatest asset and you don't insure yourself, or you're not sure whether you're insured correctly, right? You get it? So let's jump straight in and let me talk about each one of those insurances, and that way you've got a little bit more insight as to what your next steps should be. Let's talk about life. Now, life insurance is a given, right? As it says, life. It is payable on death and it is payable to your dependents. Life is there to help you and your loved ones to become financially covered if you are diagnosed with a terminal illness or you die. Most life insurance policies will pay out if you have a terminal illness. They will pay out before you pass, and obviously they pay out on death. It is, you've got to be sure that if you have people who rely on you financially, such as a partner or children, siblings, nieces, anyone, that you have this particular insurance in place. It's especially important if you have a mortgage or other debts, and you need to know who's going to receive the life cover payout, the policy owner or the beneficiary. They have to be nominated. So typically life insurance in its most important form and textbook says, make sure that you are covered to the tune of your debt levels, and about 100K per dependent should be allowed for. There are specific ways of calculating what your life insurance level should be, but at the very least, for those two things, it's really, really important. Most people have their life insurance inside their superannuation fund. Why? Well, super gets to claim it as a tax deduction, the premiums, because life insurance in your own name as a separate standalone policy is not tax deductible to you. It is because it is covering life. And so it's sitting inside your super fund is typically where it should be. The other thing that tacks onto your life insurance is what we call TPD, total and permanent disablement. So becoming unexpectedly disabled is is not only a huge physical and mental shock, it can be financially challenging as well. It's huge. You'll have to come up with the money for medical care and maybe some modifications to your car or your home. You may also have a significant gap in your earnings over your working lifetime if you become totally and permanently disabled. That's why TPD cover can be so valuable. TPD insurance provides you with a lump sum payment. It is a lump sum payment, giving you the means to access the best medical care and rehab treatments, or whatever you want to put those funds to. There is no specific clause that says you must do this, you must do that. It's simply a lump sum payout on the claim of TPD, and it will provide you with financial security, so you can go on managing the other parts of your life and to have and to be able to get on with living after that TPD event. To have a successful TPD insurance claim, you must satisfy. Now, listen carefully, because this can be quite ambiguous, and I've never really personally seen a TPD claim in the odd 30 odd years I've been around. But and it will depend on the insurance policy and the wording of the insurance policy and what they cover. But to have a successful TPD claim, you must satisfy the TPD definition of your TPD insurance policy. So check the policy, check the definitions. TPD policy terms and conditions, they do vary between insurance providers and superannuation funds. However, there is one universal requirement, and that is that you must have had a severe injury or illness that stops you from working in your regular occupation, or in most cases, one for which you have education, training or experience. Now, TPD encompasses various situations such as loss of limb, significant cognitive impairment or chronic illnesses. Most working Australians have TPD cover through their super fund. So TPD and life go hand in hand. They generally are roughly the same amount, and they generally sit inside your super fund. There are some cases that it can be a standalone policy. Again, standalone policy meaning that it is outside of super. It is not tax deductible to you, the premiums, but the premiums inside super is tax deductible to the super fund. But regardless of how you buy TPD insurance, a successful claim really relies on understanding your policy's definitions, as I've mentioned, of total and permanent disablement. So you must check the PDS and have a look at the definitions, including the differences between any occupation and own occupation policies. Let me talk about this for a minute, because this is something not a lot of people know about. Own occupation means your insurer assesses your claim based on your ability to perform the occupation that you were performing at the time of the injury or illness. Okay. If you selected any occupation is your claim will be assessed against your ability to perform any job you are qualified or suited to based on your education, training and experience. Typically, any occupation is cheaper and own occupation is more expensive. Own occupation would be selected for specialist fields such as neurosurgeons or surgery specifically. Any occupation is a broader definition by its very nature. TPD claims can take longer to assess, obviously, than any other types of insurance, particularly life insurance. That's because the medical assessment and information needed to determine whether a disability will permanently prevent you from working or returning to work can take some time, and it's just a little bit more complicated to be able to assess that, to be able to nut it down and to be able to work, progress forward from that. And so returning to work, they are assessing whether you're permanently prevented from being able to do that. And so it takes a lot longer to assess that particular situation and to establish that. And your treating doctor will be involved in this, and the insurers will request medicals and other experts to come in. So the whole process can be quite detailed and quite erroneous and take some time. It's a harder one to get past and to prove. So life and TPD go together, typically inside super. Life insurance is a given, and TPD is a lot harder to assess and put through. And the level of TPD is also typically around the same levels as your life insurance cover. Then we move on to income protection, which is totally different because income protection is covering your income, and it is basically replacing lost income if you were to become ill or injured. So income protection helps you safeguard one of your biggest assets, and that is your ability to earn an income, because you are the greatest asset here. You get up every day, you go to work, you make a living, and you get some money, and that money helps you keep on track with your financial goals and reach your financial goals and create a nice retirement nest egg, does it not? So income protection is a really, really important one to consider. It helps support you in the event that you become injured or ill and you're unable to work, with a regular monthly benefit to replace a percentage of the monthly income you'd normally be earning. So here are some specifics of a policy. These are the things, take note of these, take note of what I'm just about to talk to you about. These are the things that are particular to an income protection policy. First thing is the benefit amount, which is what am I covered for? Most insurance policies now will cover 70% of your gross income. You divide that by 12 and that becomes your monthly benefit amount. So if you claim, that is what you will receive in your hot little hands every single month, which is 70% of your gross income. And it's generally defined in a monthly amount. Then there's the benefit period. Okay, that's the benefit amount, and say you've insured yourself for $6,000 a month. What's the benefit period? How long will you pay that to me for? That's what it means. Benefit period generally can be between 2 to 5 years to age 65. Age 65 is best practice because if the injury or illness has resulted in you never being able to go back to work, that $6,000 will pay to age 65. Yeah? Best case scenario. It's not always available to everyone. It depends on your risk level of employment. So if you're running machinery or you've got a high risk job, you're working on the mines and things like that, you probably won't get to age 65. You might get a 2-year benefit period or a 5. It depends. It's an insurance company and they're assessing risk, really, at the end of the day. So it basically means if you've got a 2-year benefit period, that $6,000 that I just spoke about will pay you for the next 2 years and then it will stop. Waiting period, what does that mean? It is the time frame from which you have to wait before you can actually make a claim. So if you've got a waiting period of 30 days, you have to wait 30 days after the injury has happened, and then you submit a claim form. It could be 30, it could be 60, it could be 90, it could be 120 days. The amount of time that you have to choose in the waiting period should be decided based on how much you can afford, because 30 days is more expensive than 90 days, obviously. But also, I always say, go back and have a look at if you're working for an employer, have a look at your leave entitlements. If you've got some long service and annual leave and sick leave up to the tune of 60 days or 90 days, you may as well choose the 90 days because you're going to tap into those first before you claim in any event. So that's what waiting period means. And there is 2 other important factors to consider when you're looking at income protection. Is it an indemnity policy or is it a guaranteed amount? Indemnity generally is cheaper than guaranteed because indemnity, you don't have to prove your earnings. So if you're working and you're on wages, you can provide a group certificate over the last 2-3 years, happy days, you get an indemnity policy. It's cheaper anyway. If you're self-employed or, you've got, you're a sole trader or a company or partnership, you would choose a guaranteed policy because you cannot prove your income. That will vary from year to year. So guaranteed policy would be more expensive. But those 4 main elements, the benefit amount, the benefit period, the waiting period, and whether it's indemnity or guaranteed, are the things that you need to be mindful of when it comes to income protection. Remembering also this, that the income that you receive whilst you're on income protection is fully taxable, because the premiums that you pay, income protection, can be inside super and outside super. Outside super, it is tax deductible to you because when you do receive the income, you're going to have to put it in your tax return and declare it as assessable income. It is also available inside super. The premiums are tax deductible inside super. Which one would you go for? I always say if you can afford it from a cash flow perspective, have it outside super. If you can't afford it outside super and it's something you really have to have, you're better off having it in super than not having it in super, really. That's general rule of thumb. The final one I want to talk about is trauma. And trauma is something that not a lot of people know about. And it's probably one of the most important insurances that should be looked at. Trauma cover is designed to support you while you recover from a serious medical condition, helping you to pay for treatment and any lifestyle changes, again, that you may require, allowing time off from work for your partner to support you and to take care of everyday expenses as well. This is also a large lump sum payout. It is not the only one that pays on a monthly basis is income protection. Trauma is a lump sum payment. What's covered under a trauma policy and medical definitions can be different between insurers. So always read your product disclosure statement, PDS, and have a look at the definitions. To understand what's covered under a trauma insurance policy, read the PDS. As I say, common conditions covered are typically a heart attack, cancer, stroke, kidney failure, dementia, triple bypass, and so on. But they do have other conditions that they will cover. And again, it depends on the insurance company. Read the PDS. It doesn't actually cover any form of mental health issues at this point. That is, as we speak, not covered in trauma. So there they are, the 4 different types of insurances. Life and TPD generally go hand in hand, generally sit inside super. You've got income protection that covers your income, loss of income, that can sit inside or outside of super. And you've got trauma. Trauma is the only one that cannot sit inside super. It is a standalone policy. It is a lump sum payment to help you get through a rough patch at that particular point in time. In a nutshell, protecting yourself and your wealth is priority without a doubt. And you can learn more about how we can help you more to get the best out of your insurance and see how it's set up and how it should be set up by just speaking to one of our strategists. The link is in the description in our podcast, and the call is 100% free. So make sure you're taking advantage of speaking to one of our strategists at WOW. Make sure to subscribe to our podcast on your favourite platform. As I always say, I hope you've checked out some previous podcast episodes that are of interest to you, and I thank you for joining me.